Between 2000 and 2002, the tech industry experienced a market crash. Oracle, Adobe, ASML, all who had stock prices above $50, collapsed to as low as $8. Even IBM, who was the tech giant at the time, had its stock fall from $130 to $58. And this was the fate of the companies that got lucky. Most other tech companies like Pets.com, Boo.com, Fluz, and Webvan went completely out of business. This period is referred to as the dot-com bubble burst, and in this video, we will look at what led up to this and its impact on the tech industry. A lot of you might be wondering why it is called the dot-com bubble burst. To understand this, we need to first understand what is referred to as a bubble in the market. It is basically a situation where the prices of a category of assets become detached from their intrinsic value. This usually occurs when there is excessive speculation, unrealistic expectations, and lack of fundamental value assessment of assets. You might think of examples of some assets today which meet these criteria. As a practical example, imagine a company that is worth $100 million. This should mean if I decide to liquidate the company fully by selling all its assets, I should get $100 million. Or because of the potential growth in terms of speculated profits based on past performance, I can sell off the company for $100 million, even though all its assets at the time is not worth $100 million. But in a bubble, a company will be worth this amount even though there is no clear path of their business model turning a profit, or there is even no realistic path on their product going to the market. At some point, the prices become too high and investors switch to other ventures, or worst of all, because of the unsustainable business models, companies must file for bankruptcy. This will cause prices of the stocks to drop drastically, what is known as a bubble burst. In the case of the dot-com bubble burst, this happened to tech, or internet-related companies. To understand what led to the dot-com bubble burst, we need to go back to the late 80s and early 90s, when the technology industry was rapidly growing due to the coming of the internet. Companies like IBM, Microsoft, and Salesforce much later brought to light a new age of millionaires and billionaires. The growth of these companies was astronomical. Microsoft, for example, experienced growth levels of up to 50% per quarter. These successes led to the birth of multiple tech companies, all looking for their own slice of the internet pie. Low interest rates in the late 90s made it more attractive to invest in speculative equity investments than bonds. The Taxpayer Relief Act of 1997, which lowered tax rates for capital gains, gave even more incentives to invest in speculative assets. Now add all this to the fact that no one wanted to miss out on the next big tech company. Investing in tech companies grew in popularity among retail investors, professional traders, and venture capitalists. Also, investment banks were making a lot of money facilitating IPOs for one tech company after another. As expected, a lot of investors got greedy and threw away fundamentals like price-to-earnings ratio and just pumped money into any company that had .com in its name. All this influx of money acted like a bellows, inflating the untested tech industry into an overhauled bubble, ripe with surface tension and ready to burst. The beginning of the downfall started in 1999, when the Federal Reserve raised the Fed funds rate several times till 2000. Raising the Fed funds rate is significant because this is like the reference for most other interest rates. This increase in interest now made investing in bonds more attractive than speculative assets. As such, investors started redirecting their funds to bonds. This caused the movement of money out of speculative equities. Then what really drove down the fall later on was the onset of a recession in Japan in March 2000. News of this recession spread all over the world very quickly, introducing a lot of fear. This caused a worldwide sell-off, moving even more money out of speculative equities as most people wanted their investments to be in safer interest-paying assets like bonds. The lack of money in the speculative assets world meant everything which was inflated will have to lose its value. The internet bubble, which was at the top of this, was the main casualty. The loss in value only drove more fear in investing in these stocks, causing more investors to pull out their money, thereby driving the value even lower. This cycle kept repeating again and again. Investors pull out money out of fear, the value of the stocks go down, causing more investors to panic and pull out more money. The resulting bear market followed for about 3 years. Most companies went bankrupt, and those which were able to survive lost more than 90% of their value. Some companies which were once valued in billions and went out of business include Boo.com, Global Crossing, Northpoint Communications, Pets.com, Webvan WorldCom. To be fair, some of these companies did not have bad business models but were just ahead of their time. A company like Pets.com, which was an online e-commerce shop for pets, has a similar idea today, implemented by Chewy, which is massively successful. Also, Webvan, which was a company that delivers groceries, has a similar idea implemented by an Amazon subsidiary called Amazon Fresh. The main issue these companies faced was the cost of the logistics involved in delivering products, causing them to lose money per product sold. The irony was that the more the companies grew in terms of products sold, the more money they lost. The dot-com bubble burst led to a mild recession, causing many who worked in the tech sector to become unemployed. Adjacent industries like advertising were also affected as failing tech companies stopped pumping money into elaborate marketing efforts. You will hardly hear the dot-com bubble mentioned among popular market crashes because just about 5 years after was the 2008 recession caused by the mortgage-backed securities market and the housing bubble, which was way more disastrous on the economy. Subscribe to this channel to get more intriguing tech stories. If you loved this video, hit the like button as this helps a lot in growing this community. Until next time.